Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world, and sometimes it feels like companies are trying to hide things in plain sight. So let's see what PennantPark Floating Rate Capital Limited has been up to. Today, we're diving into a Form 8. K filing, which is like a special announcement from this company, PennantPark Floating Rate Capital Limited. Now, normally these forms are for really important events that just happened and often involve new money or big deals, so buckle up, because this one looks like it is all about a new loan and a guarantee. Before we jump in, if you are all about understanding these corporate filings and getting the real story behind the numbers, make sure you subscribe to the channel, and hey, we've got a fantastic community over on Discord all about decoding these reports. It is linked in the description below, so come join us. Alright, so the main event here is a big credit agreement, a loan deal that was signed on the 20th of November 2025. Now this loan isn't directly for PennantPark Floating Rate Capital Limited itself, but for one of its wholly owned subsidiaries, PSLF TARS PSBV LSE. This subsidiary is part of a joint venture called PennantPark S. Nino Secured Loan Fund II, LLC or PSSL2. This deal is for a substantial amount up to $150 million. This is a pretty significant chunk of change for a company in this line of business. And it is important to note that this is described as a credit facility, which means the subsidiary can borrow this money as needed up to that limit. So what does this mean for PennantPark Floating Rate Capital Limited? Well, they're not the direct borrower, but they've stepped in to provide a guarantee. This is where things get interesting. They've entered into something called a non-recourse carve-out guarantee agreement with Goldman Sachs Bank USA. This sounds complicated, but let's break it down. Recourse means that if things go south and the borrower can't repay the loan, the lenders typically can't come after other assets of the guarantor beyond what is specifically outlined in the guarantee. But there are carve-outs, and these are like exceptions to that non-recourse rule. PennantPark Floating Rate Capital Limited is guaranteeing certain obligations. Now these aren't just for anything, it is specifically for things that go wrong due to bad actions like willful misconduct, fraud, or misrepresentation by anyone involved in the deal. You know, the borrower, PSSL2 PennantPark Floating Rate Capital Limited itself, and their employees, directors, officers, and even their affiliates. So if someone deliberately messes up and causes a problem, the company's guarantee kicks in. They're also on the hook if loan money or collateral money is misused, or if there are improper transfers of assets for less than they're worth. Think of it like this: the company is saying, we'll cover the losses if you guys in charge intentionally break the rules or mismanage the money in a way that harms the loan. There is also a specific situation called a covered impairment event, which would trigger the guarantee. This happens if the collateral backing the loan loses value because of a relationship between the borrower and the company that owes the money on the loan, or if the borrower, their equity holder, or the loan manager intentionally do things that hurt the borrower's rights compared to other LN. Those who aren't connected to the company, this is really about making sure that the associated parties do not act in a way that unfairly disadvantages the loan fund. And here is a big one: the guarantee covers the full amount of what is owed if a bankruptcy or insolvency event is started, or even if a connected party colludes in one. This is a pretty robust guarantee. That limits the lender's risk on some key bad actor scenarios. So what we're looking at here is a situation where PennantPark Floating Rate Capital Limited is facilitating a $150 million credit facility for its subsidiary, which is part of a joint venture. They are providing a guarantee against specific risks, not the entire loan amount, but critical risks that could arise from deliberate mismanagement or fraud by the parties involved. This is a pretty standard way for companies to structure debt for their subsidiaries, especially when there are joint venture partners involved. It protects the lenders in case of serious issues, and it allows the subsidiary to get the funding it needs. Now let's step back and think about the strategy here for PennantPark Floating Rate Capital Limited. This looks like a move to expand their financing options or to support the growth of their joint ventures. They are essentially enabling their subsidiary to access capital, while mitigating some of the most severe risks that could arise from that financing through their carefully worded Guaranty. Looking at this from a broader perspective, it is a sign of active management and strategic use of financial instruments. Companies like PennantPark Floating Rate Capital Limited often operate in complex structures involving subsidiaries and joint ventures to optimize their investments and manage risk. The guarantee is a tool to facilitate these operations. The report is signed by Richard T. Alorto Jr., Chief Financial Officer and Treasurer, which is typical for these kinds of filings, indicating that the company's financial leadership is signing off on this disclosure. So what is my take on all of this? PennantPark Floating Rate Capital Limited is actively participating in financing. It's Operations through its subsidiaries and joint ventures, the $150 million facility is a significant amount, and the guarantee, although not covering everything, shows a commitment to managing the downside risks of these financial arrangements. The specific carve-outs in the guarantee suggest the company is focused on preventing losses due to deliberate wrongdoing. Rather than general market fluctuations, this is a smart approach to safeguarding their interests. The main risk I see here is always the potential for those carve-out events to occur. Even with careful management, things can go wrong, especially in complex financial structures, while the non-recourse aspect provides a layer of protection. The guarantee itself still introduces a potential liability for the company. If these specific bad events happen, the opportunity, though, is clear. This financing likely supports a growth initiative or an important investment for the company. In conclusion, PennantPark Floating Rate Capital Limited is using financial mechanisms to support its business activities through its subsidiary and joint venture. It is a strategic move that balances access to capital with risk management through a targeted guarantee. Overall, it appears to be a calculated step to enable further business development, while keeping a close eye on potential liabilities stemming from misconduct rather than general market risks. Alright, that is our breakdown of this Form 8. K-filing, what do you think about this credit agreement and guarantee setup? Could it be a sign of good things to come, or are there hidden dangers? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into corporate finance. Don't forget to join our Discord community for more discussions on these topics. It is linked in the description below. Thanks for watching, and we'll see you in the next one.